You might have some spare money and are thinking of getting into investing. You may have heard of people becoming millionaires from investing into companies like Amazon and Tesla, but you're anxious of the potential risks, like what if you lose all of your money from one bad investment, and thinking that you need to spend hours of your time researching companies. And all you seem to hear in the news is that we're in a recession or that the stock market's crashing. So how do you filter out what information is actually going to be helpful? And there's lots of different terms that get thrown around, like ETFs, index funds, and dollar cost averaging. All of these factors can leave people confused and asking a lot of questions, like, isn't investing risky? What if I lose all of my money? And is it actually safe for me to invest using brokers like Sharesies and Hatch, or should I just leave it up to a fund manager because they have more experience than me? And how do I actually know what to invest in, and how much money will I need? I'll break down everything you need to know about investing, because it may sound like a very risky and complicated process, but once you have all the relevant information, it's actually surprisingly easy. Finally, I'll tie everything together by showing you how to actually buy shares of a company using the New Zealand brokerage platform Hatch. So when should you start investing your money? Really, the earlier the better. No matter how old or how young you are, you should always get into investing. No matter if you're 15 or 50, it doesn't matter. Starting on investing, the earlier the better. But it's important that you get rid of any debt that you might have. And I'm specifically referring to having any vehicle that you've purchased on finance or the interest on a credit card. So with credit cards, the interest can be up to 17%. So you're constantly going to be losing money by paying off the debt that you've accumulated. So you need to get rid of that debt before you start investing your money, because once you get rid of that debt, you'll stop losing money on the interest that you have to pay on it. Of course, a debt like a student loan or a mortgage on a house is different because the amount of money is much larger and can't be paid off very quickly, and it's for something beneficial like having your home to live in or furthering your education through tertiary studies. And you definitely don't need a lot of money to get started with investing. People might think that you have to have thousands of dollars, but all you really need is just $5 and you can begin your investing journey. And most brokerage platforms give you sign up bonuses if you use someone's referral link when you're making your account, and these can vary from $5 up to $20. And I've got a referral link for both Hatch, Stake and Sharesies down below in the description box if you want to check those out when you're making your account. But there's no minimum purchase amount for any of these platforms, so even just $5 will go a long way. And it's all just about starting, because once you start, you'll begin watching YouTube videos about investing, reading books. As your confidence grows with more knowledge that you have, you'll start contributing more and more money and consistently making a greater profit and having a growing portfolio. It's the same way with starting at the gym. You don't expect to look like a bodybuilder overnight. You know it's going to take time, dedication and persistence to help you achieve your goals. It's just the same with investing. Don't be worried about the idea that you don't have a lot of money now, because you're going to have a lot of money in the future if you start early. Let's say you're sold on the idea of investing and you're trying to figure out the best place to put your money. The two main options that you have in the stock market are ETFs or individual companies. So we'll start with ETFs, and this just means exchange traded fund, and essentially it's just a collection of companies clumped together based on a particular investment goal. There might be ETFs that track the largest 100 tech companies, those that look at the largest dividend yielding businesses, and then there's also ETFs that will track the overall performance of a country's stock market. So in New Zealand there's the NZ Top 50, in Australia the ASX 200, and then in America the S&P 500. The S&P 500 is deemed to be an accurate representation of the overall global stock market. So it's just a collection of the top 500 biggest publicly traded companies in America. When you're starting out with investing, ETFs really are the most safe and effective way to go, because your money is diversified amongst multiple different sectors and different companies. It gives you a very consistent return and you're not at the mercy of just one business. And in periods where there's some economic recession or more financial instability, then ETFs are much safer and don't have as much volatile price fluctuations as individual companies might have. So the S&P 500 is really the gold standard in terms of investing, and it gives you a nice consistent return of 10%. 7%. So when you're putting your money into this, you're essentially getting a nice diversified portfolio that includes some of the biggest companies, or really the majority of the biggest companies in the world. If you look at the breakdown of the S&P 500, the top 10 include Apple, Microsoft, Google, Tesla. So looking at Apple, it's over a $2 trillion company in terms of its valuation. It makes up about 7% of the overall S&P 500 index. So if you're starting out, definitely pick this investment. And if you want to put a little bit more time aside and start researching individual companies, then that's also an option for you. So with individual stocks, there's a few different criteria that you're looking at. Probably one of the biggest things is the market cap or the size of the company. Now, the reason that this is important is because it determines how much money is needed to drive the price of that business up or down. So if it's a relatively small company, taking a look at something like NEO, whose market cap is just over $30 billion, you can look at its price chart and see how volatile the company is, having over a 2,000% increase in the value of its share price between March 2020 and January 2021. However, you can see as we're coming into a bit more financial instability and we're potentially heading into a recession, that company is having a significant drop in its value, coming down over 66% from February 2021 to August 2022. In comparison to something like Apple, which over a 5-year period you can see the stock graph looks a lot smoother and it's just had a nice consistent increase in value. However, the market cap is $2.6 trillion, so substantially larger than NEO, so it's going to take much more money for there to be any rapid price fluctuations. The stocks are broken down into small, mid, large and mega cap companies, and mega cap businesses are blue chip companies. They're essentially the leaders in their field. Think of brands like Apple, Facebook, McDonald's, Coca-Cola, very clear, recognizable businesses. So if you want a bit more security and a faster growth than an ETF like the S&P 500, you might look at putting your money into large blue chip companies, because then you're getting a faster growth rate. However, there's still a fair bit of security because the company is so large. And then if you're looking at smaller growth stocks, ones that borrow a lot of money, maybe things like Square or Roku, which can be a lot more volatile but also can give you a much greater increase in value. So looking at something like Square, which is a growth company which borrows a lot of money to fund the business, and the value or the share price is determined by the future perceived value of that company, how much it's going to be worth in the future. They do end up taking on a lot of debt, so when there's poor economic circumstances like what we're having now, you can see that these growth companies that borrow a lot of money do have very sharp drops in their share price. When there's a lot of money in the market and we're having a bull run, they go up much more than a blue chip company. You can see how much Square went up from April 2020 to May 2021 in comparison to Apple in the same time frame, had nowhere near that much increase in its share price. So it's really about risk versus reward, and of course with individual companies you need to do more research of your own and have more understanding in comparison to an ETF where you can just consistently dollar cost average, put in $50 a week for decades at a time and know that you're going to make money from it. So that's really how you have to play it. How much research, time and energy do you want to put in, and how much money are you willing to lose or potentially lose in the short term? Because a lot of people are worried about the risks or the potential chance of them losing money with investing, and you only lose money when you sell your investment. So it might be easy to look at something like Square and think that's far too volatile, I would never buy into that, but you have to keep in mind that investing is a long-term game, and just because there's periods of time where the market is moving up consistently, that doesn't mean you buy always, and just because it's dropped doesn't mean you sell. So as a practical example to show you how investing can be more or less risky depending on your behavior, looking at Coca-Cola, you can see that in December of 2018 the value of one share was about $50 US. If you held from that period of time in 2018 up to February 2020, you would have been up close to 23%. However, during the pandemic there was a significant drop in the share price of Coca-Cola. Just like many other companies, Coca-Cola went from $60 a share all the way down just to $38 a share in just a few months. So it went down over 36% in a very short space of time. However, if you had just held on to your investment when you bought it back in February of 2018, you would have still been up 30% at this point in time. So it's all about holding on to your investment. If you just sell when the market drops, then you're most definitely going to lose money. However, if you hold for the long term, then you're going to have a nice consistent growth in the value of your portfolio. There's also inherent risk if you're putting in money into the stock market that you immediately need. For example, if you're saving up to buy a house or you're investing the money that you need for rent, then it's going to be a very stressful time. The money that you put into the market, you can't need for the next 3 to 5 or even 10 years ideally. Because if you're investing money that you need in the short term, which again is a minimum of 3 to 5 years, then it's going to be a very stressful period. Let alone if you're investing money that you're going to need next week, then there's absolutely no reason that you should be putting that into the stock market. And again, you don't have to put a lot. If you only have $50 at the end of the week to put into the market, or even just $50 at the end of the month, then it's still worthwhile putting that in and then consistently growing your portfolio over time. And with anything, there's always some degree of risk. Even KiwiSaver, which is deemed to be a very safe government-backed savings plan, can have price fluctuations. Taking a look at the coronavirus pandemic, where people saw massive price changes and drops in the value of their KiwiSaver, leading them to panic and desperately trying to withdraw their money. And with KiwiSaver as well, people are happy to put in 3 to 10% of their income for the whole duration of their working career, but they might not really look into it at all. They might not compare the average return of a balanced fund compared to a growth fund. They might not compare the fees of Westpac to ANZ. How much money will they be charged to use the savings plan? Or even knowing where their money is going, they might have selected a growth fund, but they don't know what companies are in there and if they're actually good investments. So there's a lot of things that people don't really look at, and they're quite happy to part with a lot of their money and put it into a scheme like this, but not know anything about it. But then look at something like investing in the stock market themselves as something that's very risky and unpractical. So lastly, how do you actually buy shares of a company? First of all, you're going to need a broker. In New Zealand, there's a few different options to choose from. So you have Hatch, Stake, and Sharesies. The broker that I personally use is Hatch. So in terms of setting up a brokerage account, it's very straightforward. All you need is your ID number, proof of identity, either a driver's license or passport number, and then all the regular pieces of info like email address and phone number. Just send that through, and then all your information gets verified and you can make your account. So this is what the home screen of Hatch will look like. And then if you want to browse shares to purchase, just click on browse in the top left corner, and then click on exchange traded funds, because we're buying the S&P 500 ETF. Once you click on that, the S&P 500 will be one of the first companies to show up. So it's the one offered by Vanguard. Click on that, and then it's going to give you a few different purchase options. So once it's loaded, you can look at the price movements of the ETF from different time periods: 1 day, 3 months, 1 year, and also 5 years as well. And then as you scroll down, just click on buy, and then it's going to give you a few different buying options. I always go with market buy order, which is just buying the shares of the ETF at the current market price. So you just put in the amount that you want to invest, and then you would just hit review market buy order, and then those shares will be purchased for you. If you want a more direct breakdown of the different New Zealand platforms and how they compare to each other, make sure to check out this video on screen so you can make an informed decision on which broker is the best for you. I'll be showing you everything from setting up an account to making an investment to help you get started with your investing journey.